Okay.
Good morning, everybody. The December 2nd, 2020 School Land Board meeting will now come to order. Pursuant to the Governor's executive order to avoid gatherings of more than 10 and the Governor's March 16, 2020 suspension of certain provisions of the Texas Open Meetings Act, this meeting is being held by video conference call as authorized under the Texas Government Code, Section 551, Tech 125. Access to the meeting is provided to members of the public, and it was published in advance in the Texas Register in accordance with the Texas Open Meeting Act. Any member of the public who wishes to address the School Land Board on a matter within our authority should indicate as much at the beginning of this meeting or during any public comment period. Have the opportunity to limit the amount of time available to each individual that seeks to weigh in on today's agenda. Assuming no other housekeeping items at this time, I could ask the board to review the minutes from our prior meeting, which was on October 20th, 2020. And assuming no questions, comments, or objections on the minutes, I could entertain a motion to confirm them for the record.
Motion to approve.
I think you had Gil and I both on that, so a motion and a second.
Thank you for clarifying. Motion is made, seconded, and carries to approve the minutes. Next item on the agenda is approval of the consent agenda. Similar to the minutes and confirming for the record after the board has had a chance to review, and assuming no questions, comments, or concerns at this time to raise with staff, I can entertain a motion to confirm the consent agenda as posted.
This is Michael. I have no questions and move to approve the consent agenda as posted.
Second.
Thank you for that. Item is made in a motion. It seconds. There's a second and it carries unanimously to approve the consent agenda as posted. Next item on the agenda is number 3, consideration action on applications for coastal easements on coastal public lands.
Good morning. This is Amy Nunez with Coastal Field Operations. Coastal Easement 830163 is a new contract for existing structures. The Schoenstatt Sisters of Mary is a religious site and retreat. It's a nonprofit used to conduct workshops and provide guidance to at-risk youth, families, and women. The structures at the site consist of a pier, some existing fill, and shoreline stabilization. It's located in Aransas Bay, or more specifically, St. Charles Bay in Aransas County. The Schoenstatt Sisters have coordinated with staff and have requested a reduced rate based on the use at the site and also their continued efforts to rebuild the pier and other structures following Hurricane Harvey. Staff calculated the project at 1 cent per square foot for this upcoming contract term. This is consistent with the Boy and Girl Scout camps, some special needs camps, and also another religious encampment located on state-owned submerged land. The total at this rate was $20.28 per year. Therefore, at this time, staff is recommending the $100 a year minimum rate for a coastal easement 2 and a standard 10-year contract term. Original rent at a normal calculation would have been approximately $700 per year. I'd be happy to answer any questions regarding this project.
Any questions from the board at this time? For what it's worth, board, I asked staff to perhaps think about or perhaps put together a strategy for nonprofits that make these types of requests and the price points that they could potentially enter into in the event of natural disasters on the Texas coast. This is a unique circumstance, but obviously would do a lot of good on the Texas coast.
This is Michael. I move to approve.
Is there a second?
I'll second.
Motion is made, seconded, and carries to approve item number 3. Thank you very much, Amy.
Thank you.
Item number 4 is going to be held in executive session. We'll enter into it pursuant to Chapter 551, Subchapter D, Section 551, Tech 071 of the Government Code for discussion, consideration, regarding pending litigation and or settlement offers and to seek attorney advice or counsel related to item 4 on the docket. We'll also enter executive session under subsection 551 Teco 72 for discussion consideration concerning purchase, sale, exchange, lease, or value of real property related to item 4 on the docket. Following executive session, we will reconvene in open session. The open session of the December 2nd, 2020 school land board meeting will now resume with item number 4.
Commissioner, I don't see Bill Farr on the screen. So this is Ken Mills. I'm the director of the Oil, Gas, and Energy section in the Office of General Counsel. And staff recommends approval of the lease to Texrox LLC on the terms and conditions as discussed in executive session. I'd be happy to answer any questions.
Any questions from the board at this time?
No, this is Todd. I'll move to approve.
I'll second.
Motion is made, seconded, and carries unanimously to approve item number 4. Thank you, Ken.
Sure.
Final item on the agenda is a non-voting item, and that is Mr. Martin's quarterly investment report for the period ending June 30, 2020.
Thank you, Mr. Chairman. Members, for the record, I'm Rusty Martin, Chief Investment Officer of the General Land Office. I'm pleased to present you with a quarterly investment report of the Texglo Permanent School Fund Investment Portfolio for the period April the 1st through June 30th, 2020. As you know, the performance measurement calculations and the statistical data that are contained in the report were prepared by State Street Bank and its Private Edge Group, which are the custodial accounting and performance measurement agents for the portfolio. Beginning with the executive summary, which is on page 1 of the report. Quite a lot happened in the first quarter, as you are aware. Second quarter. U.S. GDP dramatically decreased at an annual rate of 31.4%. That was following a decrease of 5% for the first quarter of the year. Across the country, the decreases ranged from 20.4% in Washington, D.C. to 42.2% in Hawaii. Texas GDP decreased 29% during the period. This decrease, of course, reflected the continuing economic response to the COVID-19 pandemic. As you'll recall, shelter-in-place orders were issued in March and April, and those led to rapid decreases in economic demand as businesses and schools switched to remote work or canceled operations, and consumers canceled or redirected their spending. This resulting destruction in GDP growth peaked in the second quarter, even as some shelter-in-place restrictions began to be lifted or relaxed in some areas during May and June. And government pandemic assistance payments began to be distributed to households and businesses. The U.S. unemployment rate ended the quarter at 11.1%, which was up from 4.4% at the end of the first quarter, also reflecting the early effects of the pandemic. Following the series of actions that the Fed took in March to decrease its target Fed funds rate from a range of 1.5% to 1.75% down to a target range of 0% to 0.25%, the FOMC indicated at its June meeting that it would maintain this target rate range until it is, quote, confident that the economy has weathered recent events and is on track to achieve its maximum employment and price stability goals, end quote. In addition, they also reaffirmed the continuation of their balance sheet normalization program that they launched in October 2017, which, as you know, centers around the reinvestment of principal payments from its holdings of agency debt and agency mortgage-backed securities and the rolling over at auction of maturing Treasury securities. Also, they stated that they would continue monitoring the implications of incoming information for economic outlook, including public health information and global developments, and would use its tools as appropriate to support the economy. In addition, the timing and size of any future adjustments in the Fed funds target range would depend upon the FOMC's assessment of, quote, realized and expected economic conditions relative to its maximum employment objective and symmetric 2% inflation objective, end quote. As far as the sectors that we invest in our portfolio are concerned, starting with real estate, the core U.S. commercial real estate market, which is generally measured by the unlevered NCREIF Property Index, which I'll refer to as NPI, returned 0.99%, a negative 0.99%, basically down 1% for the quarter into June 30. That was the lowest return since the fourth quarter of 2009, in the midst of the financial crisis that ultimately led to the Great Recession. The trailing one-year return was 2.69%. Both rent and NOI growth rates reflected the largest decline since NCREIF started collecting data, which goes back to 1978 for NOI and 2001 for rents. Surprisingly, however, overall occupancy rates were still relatively unchanged at about 94% during the quarter, although hotel occupancy decreased dramatically to about 50%. However, we should note that occupancy probably remained unchanged for the other property types because the associated space was still considered leased, even though it's probable that many tenants did not pay rent during that period. Therefore, it's probably too soon to determine the full extent of the impact of COVID-19 on occupancy levels that are reported to NCREIF. It's also interesting to note that transaction flow decreased during the quarter significantly from an average of 100 to 200 sales down to about 30 transactions, resulting in challenging price discovery for appraisers and less liquidity for investors. Looking at the returns for the NPI property sectors during the period, all of the sectors were lower in the second quarter and were negative for all sectors except industrial. Second quarter gross total returns for each of the sectors were: hotel was down 16.59%, retail was down 3.85%, apartments down 0.63%, and office was down 0.5%, and industrial was up 1.02%. Again, industrial was the best performing sector during the quarter, as it has been for several quarters, and that's due to its continued strong performance in the industrial warehouse space. Moving to the energy side, WTI spot crude oil prices averaged just under $28 a barrel during the quarter, but they ended the quarter at about $39 a barrel. That was a 91% increase from the first quarter ending price, which, as you'll recall, was about $20.50 a barrel. That rebound resulted from an improvement in global oil balances. Following the first quarter perfect storm of increased supply and an epic reduction in global demand, oil demand bottomed in April at about 79 million barrels per day. That was down 27% from the fourth quarter of last year, where demand was about 101 million barrels per day. In early April, OPEC Plus agreed to remove about 10 million barrels a day of oil from the market, and that action, in conjunction with estimated shut-ins of about 4 million barrels per day, helped stabilize oil prices. Global oil balances rapidly improved during the second quarter, from a surplus of about 19 million barrels per day in April to a deficit of around 4 million barrels per day in early July. However, most analysts expect this pace of improvement to taper off as OPEC Plus and U.S. production come back online and demand improvements slow. WTI prices are likely to remain range bound in the $40 per barrel range through the end of the year. Yesterday, WTI closed around $44.50. There may be steep global inventory draws in the second half, but they're probably not going to be enough to fully reverse the 9 million barrel per day first half builds in the first half of 2020. Most analysts expect a net surplus at the end of the year of around 1.7 million barrels per day. In the near to medium term, demand and pricing is going to remain volatile. Of course, that's due to COVID-19 and also continued trade war tensions with China. uncertainty regarding the pace of production growth and drilling activity. During the remainder of 2020, oil prices will be driven by the pace and the magnitude of global demand recovery, and global stimulus and human behavior are going to be key factors in that ultimate outcome. Looking at natural gas prices, they averaged $1.70 per million BTUs during the second quarter. They ended the period at $1.76. It's about 3% above the first quarter ending price of $1.71. Continuing COVID-19 demand destruction and geopolitical tensions continue to exert tremendous downward pressure on gas prices during the quarter. This is the third time since April 2016 that gas traded below $2 per million BTU. However, things have improved somewhat for the gas industry since then. In fact, even though most analysts expected gas to remain around $2 for the rest of the year, it actually is trading up around the $3 range. So has improved dramatically. Moving to the performance numbers. If you look at page 2 of the report, the total NAV at the end of the period was slightly over $4 billion, 4.001 billion. Of that amount, 3.818 billion or 95% were investments, and cash equivalents were right at our target, 5%. It's about $183 million. As far as returns are concerned, our gross returns without cash, we had a good quarter. We were up 2.19% versus a benchmark that was actually down a little bit. It was down 0.06%. So we outperformed the benchmark by about 225 basis points. The real estate sector of the portfolio was actually down for the quarter, 1.03%. So maybe we are starting to see a little bit of a crack in the real estate sector. We'll keep an eye on that as we go forward. But as you know, it has performed very strongly for the past several quarters. Infrastructure was up for the quarter significantly at just under 4.5%, and energy was up 2.71%. As far as longer term returns, 1-year return, we're still taking it on the chin there, down minus 12.98% versus a benchmark that was up 3.52%. And of course, as you know, primarily that's related to decrease in values in energy investments. For the 1-year returns on the individual sectors, energy was down 36.6% for the 1-year period, while infrastructure was up 3.27% and real estate was up 4.5%. So that's where the minus 12.98% comes from for the 1-year return. Longer term returns much better. A 3-year return for the portfolio is 4.97 versus 5.37 for the benchmark, so slightly under the benchmark, 40 basis points. But longer term, 5-year and 10-year, we significantly are still outperforming the benchmark. 5-year returns 8.44 versus 6.04 on the benchmark. It's 240 basis points outperformance. And of course, on the 10-year, 13.09% versus the benchmark of 8.95. So outperforming the benchmark there about 414 basis points. At the end of the period, about 34% of our total existing capital commitments remained unfunded. That was about just under $2.8 billion and represents 29% of real estate, 36% of infrastructure, and 35% of energy commitments that have yet to be funded. Moving to page 3 of the report, new investments. As you can see, there were no new capital commitments approved by the board during the second quarter. However, as indicated on page 15 under subsequent events, the board did approve a $100 million expansion of an existing $200 million capital commitment to NCAP Energy Transition Fund 1 during the period. Moving to asset allocations on page 7 and 8 of the report. On a purely invested basis or NAV basis, the allocation to real estate at the end of the period was 31% versus a target of 33%. Infrastructure was at 39% versus a target of 32%, and energy was at 30% versus a target of 35%. Over time, these allocations will become more aligned with our policy allocation targets as the board makes new capital commitments in various sectors and as more of the existing unfunded capital commitments become funded. Most of the shift in allocations during the period, of course, is caused by extreme levels of volatility in the energy markets, as reflected in our energy sector investments. On page 8, the allocations on an invested plus unfunded commitments basis is shown. Real estate there was at 28% versus target 33. Infrastructure was at 38 versus its 32 target, and energy was at 34% versus its 35% target. Looking at geographic diversification on pages 11 to 12, we're relatively close to our targets. We're currently 94% allocated to the US versus a target of 90%, and we're 6% internationally allocated versus a target of 10%. And then moving finally to our investment manager exposure, which is on page 13 and 14 of the report. On a purely invested basis or NAV basis, we're well diversified across a platform of 25 investment managers. Our policy statement limits our exposure to any one manager to no more than 20% of the total portfolio. At June 30, we were well within that range. The top 5 highest exposures were to EnCap Flatrock Midstream at 10.68%, USAA 9.63%, Macquarie Infrastructure Partners 8.66%, EnCap Energy at 6.69%, and Clarion at 6.06%. The co-investment vehicles are grouped by manager and presented separately. At the end of the quarter, the highest grouped co-investment exposures were EnCap Flatrock at 8.19%, followed by First Reserve at 5.24% and BlackRock at 4.61%. That concludes my presentation. As the commissioner indicated, this is a non-voting item, but I'm happy to answer any questions you may have.
Thank you, Rusty. Any questions from the board at this time?
None here, Commissioner.
I have none.
Well, thank you to the board. Thank you to the staff. And thank you, Rusty, for the wrap up. As we head toward the holiday season, I hope everybody stays safe and healthy in more ways than one. And hopefully we can find some opportunities in this chaos. Thank you, Rusty, for that. And thank you especially to the team. This being a non-voting item and no other business on the agenda, this meeting is hereby adjourned.